to this. I just go to the next one yet. 14. So far I was very general. What I said, actually, you will find out this is even true. It's usable in insurance companies. It's usable in banks. It will also be usable even in non-financial companies. But now each of these sectors, banks, insurance, there you have to distinguish between life and non-life, and non-financial, they have some specific needs in dynamic simulation. I will discuss only the banking need. If you are interested about insurances, then read the other chapters 15, 16, and 17, where we describe each case. So, because dynamic simulation is close to the business. And they are so different in business, of course, the dynamic simulation needs some different assumptions, some different strategies. Now we focus on banks only. We mentioned already chart of account before, that if we come to dynamic simulation, we need a chart of account because that will help us to fulfill the completeness and consistency conditions. And it will only be complete if you have the cash flow balancing account, the accrual balancing account. But the initial model which Yannis gave you contains that. So we make sure that this is consistent. We said already it's a chart of a first order product catalog. And we know once we have got all the data, we know we have the full balance sheet. All the contracts are there. So the starting condition is complete. So what we have to do now is giving conditions how it will continue. A classical balance sheet to simulate in banks is this one here. So you have liquidity, interbank, loans, mortgages. That depends a little bit what kind of banks you are. And of course, in your model, you look at the type of bank which you are. You get a balance sheet from the internet somewhere, and you do about this, and just be a little bit not too fine in detail. You know, small items. I have at the end here others. Often this is a long list of small little things in banks. Some kind of maybe on the liability side, reserves or whatever. So there can be quite a bit. So make it, just think about the product here. So that's a typical thing. And now what I'm going to discuss is how you forecast certain groups of assets and liabilities. Because even inside here, the forecasting of loans or mortgages or the trading forecasting is very different than the one of mortgages, for example. Some business is sluggish, slow. Other ones is highly volatile. So you have to do different type of strategies. So we start with loan mortgages and bond issues. This is the most easy to forecast. Often they are slow, predictable, and so on. This kind of here. So you define the product mix. Often it's PAM and RGMs. So you define that. You know about the term to maturity, what you are going to plan. That, of course, has a lot to do with the business plan of the bank itself. You know, they will know. For example, if they are in an area where there's a lot of construction, they are going to expect a lot of mortgages to happen. If you are in an area where everything is built over, no mortgages anymore, so you do maybe some other business. So this kind of knowledge, of course, enters now when you do the dynamic simulation. So that's for loans, so that's rather easy. For example, RiskPro is used strongly at Kreditanstalt für Wiederaufbau. That's the German reconstruction, but that's the German bank actually. All the big monies about Greece and so on, probably they hold it really. So they have very long-term business, and it's very kind of easy forecastable because a lot of the existing business will be rolling in the next 30 years. So that's already known except the credit default, of course. So that's very easy because you have a lot of this. These are huge volumes, tremendous volumes. So then now another category to forecast are current accounts, saving accounts, and deposits. Now, volume is easy because normally it's sluggish except in the liquidity crisis. Then they become fast. Huh? But for an income, a saving account is very easy to forecast. You need a replication portfolio in the background. That makes it a little bit more difficult. And the rate is also kind of easy because you know, if you are a bank, you know a little bit what is happening in the saving markets. You know, the other your colleague bankers. You know, you play it a little bit together. You know, if rates go up, you keep it lower a little bit. You know, so this kind of things you tend to know, but still they need some kind of model. So you have this model for volume and rate. So S is a saving rate, V is the volume. Now this is only an example. Actually, there are only parameters here. But often that the saving rate is a sluggish rate, partially depending on long-term rates, having a big minus constant, things like that. Volume is also a moving average kind of type of things in the normal case. So you model this as we said. Now, very difficult to forecast is trading, off-balance sheet things, because these guys are volatile. You know, they jump for the next possibility, you know. So you have this position now, you have another position there. So there are different forecast techniques to do that. Either you try to directly forecast income and not really volumes, or the contracts. And that's an interesting case here. For example, some banks, they have risk limits. Let's say you have an interest rate risk limit. So this formula, and it's closer described in the book actually, gives you the formula how you instruct the system to create off-balance sheet transactions. And basically, you look at the actual sensitivity minus the limit sensitivity, and that gives you, and you see on which side you are. If you are inside, then you don't do anything. If you're outside, and then you take the dollar sensitivity, you are outside, and you take the dollar sensitivity of a unit of hedge, and of course the two sensitivities give you the ratio of how to hedge. So that is described a little bit closer in the book. I think it's an interesting case. And I saw banks doing it like that. So they had overall restrictions on the balance sheet, on the interest rate risk. So the system itself, if you do, due to your instructions, you say, for example, I go long-term in assets, that increases the duration of your equity. It might increase it over what you're allowed to do it. So then automatic hedging will happen also in reality, and you can model that already into the dynamic simulation. And then the last one is liquidity interbank. So how do you model liquidity interbank? And that is normally the cash flow balancing actually. So you have an initial start, and in reality, the treasurer is that balancer. So the one which we model inside the software, there's a real counterpart. So normally the treasury has a starting part, a starting volume, and gets the whole balancing over time. That's what they have to do. And then if the treasury grows too strong, too big balance sheet items, you can use the last formula to reduce that item. Then finally, the last thing to forecast is equity. And how do we forecast equity? The answer is it has been already forecasted in everything else. It can only be a logical consequence. So there's nothing really to forecast about equity. You forecast equity by forecasting everything else except equity. That's anyway the definition of equity. Equity is everything else except itself. So you sum everything up and you get equity. And you can do very nice simulations. This is a liquidity gap analysis for regulation purpose, a real case with limits. That is a forecast of the balance sheet. So you can make now real, and RiskPro produces it automatically. you get a forecasted balance sheet, and always shadowed to the balance sheet, you get already a P&L. For every balance sheet item, you get a P&L. So it sounds maybe a little bit strange, but it is like that. And why is it like that? Because included in the financial contract which belong to a balance sheet item, there's already a P&L attached to it, like interest income, interest expense, FX income, FX. So all market-related stuff is already there. So for every asset item, every liability item, there are a few lines of P&L. And so these you see there. You see this is really balance sheet item, book value, something like that, nominal value, and interest income, FX, and so on is then P&L related. So these are the P&L items which have to add up then to the growth of capital. Now this is book value oriented. So now you think now we are fully in bookkeeping. We are not. That is one possibility, and by the way, it's an important one, because often how a bank is judged is like this. This is how the world sees it, and this is how you are treated then. But if you don't like book value, then you do an MPV, the bank. So now with risk pro, it's possible to do it on market value term. You just tell it, of course, it has all the market conditions, they go along over time. So it is capable to do the valuation over time. So you can, in parallel, look at it in MPV terms, in book value term, so that is all possible in sensitivities. And if you like to combine it with dynamic Monte Carlo, then run a dynamic Monte Carlo and see how then your value income, everything disperses over time. So it's, but the same technique applies now. But here you have to do a dynamic forecast, a dynamic economic forecast. You can even integrate market and credit risk. There are items here you see we had the book value we saw before. Now then this is the book value including credit risk. Now this is the credit risk free book value. What is the difference? Provisions, which you have done already. Huh? So you have already 40 provisions in this case. That's why the book value is 960. 1,000 is the notional without credit risk. So you have the provisions here. You see that here. And then you see the book income, the interest income, FX, security gain. And here are the credit risk effects. So credit risk effects are true losses on one hand, or revaluations due to if the rating goes, for example, from A to B. You have another discounting rate. You get another value. So and this loss is due to credit risk loss and will be then here shown as provision change. So you have the direct losses, which are cash flows which will never come, the other losses which are due to rating changes. So you can have them all in one forecast, and you see that everything. You even can do funds transfer pricing dynamically, which separates your income from risky income to non-risky income, and the risky income, how much is due to credit risk and market risk and all that. Quite powerful. So you must make sure that you will, if you go to a bank, that you will have systems like that. Because of course, if you go now to a real bank, one which doesn't use this kind of system, this is all spread around and you never see that nicely. But it is possible if you organize it from bottom up quite well. So much for dynamic simulation. Read chapter 13 and 14 exactly and ask me. If you have questions on dynamic simulation, maybe ask me directly. So not on technical questions, that's Yannis, but content questions. You can send me directly an email. Any question? Everything clear, and it is a kind of clear, because what we do, we are just natural, no unnecessary abstraction. Just think like the world really works. And what you need is then a good system, which can model that world, that's everything. But it doesn't strain your brain really, not unnecessarily. There's enough strain other places. So strain it only where you have to strain it, and not anywhere else. Yeah, if not, then I think that's it. Thank you very much. And next 2 times you will have only seminars. And for next time, you really should be able to do all your solves, etc. And if you have problems, come a little bit early. Yanis will be here. And so he will fix those problems. Okay. Thank you very much. Bye-bye. Thank you.